Hello and welcome. If you're starting to get interested in investing, you've almost certainly come across a seemingly mysterious term, the S&P 500. It pops up on the news, in online articles, and in conversations with people who seem to be in the know. And it can sound like a complex code, reserved for Wall Street experts, but the truth is very different. The S&P 500 is actually one of the simplest, most effective, and most accessible investment tools out there, especially for beginners. And the goal of this narration is to completely demystify it for you. We're going to answer three fundamental questions. What exactly is the S&P 500? Why is it so important? And most crucially, how can you, as a beginner, actually put your money to work in it? Let's start with the definition. S&P 500 stands for Standard & Poor's 500. Standard & Poor's is simply the name of the company that creates and maintains this index. And the 500 represents the number of companies within it. Now, imagine the entire US economy as a massive commercial city, a giant main street with thousands of businesses. You have everything from the small corner store to the huge shopping malls and corporate skyscrapers. The S&P 500 is the list of the 500 most important, solid, and influential establishments in that city. These aren't just any companies. They're the giants, the ones you know and use every day. Think of Apple, Microsoft, Amazon, Google through its parent company, Alphabet, Tesla, Johnson & Johnson, Visa, McDonald's. The list is full of household names. These companies are the engine of the American economy. That's why, when you hear a commentator say the market was up today, they are almost always referring to the performance of the S&P 500. It is the market's thermometer. But there's a crucial detail. The S&P 500 is not a list where all companies are equal. It's structured by a concept called market cap weighting. Market cap is a company's total stock market value, calculated by multiplying the share price by the total number of shares outstanding. This means that the highest valued companies have a much greater influence on the direction of the index. Let me give you a visual example. Even if you only listening, imagine a giant pie chart representing the S&P 500. A huge slice, representing about 7%, would be Apple. Another large slice would be Microsoft. And so on. Smaller companies on the list, like a Foot Locker, would be mere slivers in that pie. If Apple has a great day and its stock goes up, it pushes the entire index up significantly. If Foot Locker has an exceptional day, the impact on the overall index is almost negligible. This characteristic is important because it reflects reality. The giants truly have a disproportionate impact on the economy. Now that we know what it is, why is it so revered by investors? Three key words: diversification, performance, and accessibility. First, diversification. This is perhaps the most important concept for a beginning investor. Diversifying means don't put all your eggs in one basket. If you buy stock in a single company and it does poorly, your loss can be substantial. However, when you invest in the S&P 500, you are automatically buying a small piece of 500 different companies. These companies are spread across various sectors: technology, healthcare, finance, energy, consumer goods, and more. If the technology sector has a bad year, it's possible that the healthcare or energy sector will do well, balancing out the drop. It's instant diversification in its purest form. Second, the historical performance. Over many decades, the S&P 500 has been a powerful wealth-building machine. Now, it doesn't go up every single year. There are drops, sometimes severe ones, like in 2008 or 2022. But the long-term trend, looking at a chart over 50 or 70 years, is clearly upward. The historical average annual return is around 10%. To illustrate, if you had invested $10,000 30 years ago and simply left the money there, reinvesting the dividends. And third, accessibility. You do not need to be a millionaire or an expert to invest in the S&P 500. You do not need to buy individual shares of 500 different companies. That would be incredibly expensive and a logistical nightmare. There is an infinitely simpler path: ETFs. ETF stands for Exchange Traded Fund. Think of an S&P 500 ETF as a pre-made basket that contains a tiny piece of each of the 500 stocks in the index. When you buy a single share, a single unit of this ETF, you are, in one transaction, becoming a tiny shareholder in all 500 companies. It's that simple. The most popular ETFs that track the S&P 500 have very well-known tickers or trading codes. The most famous is SPY from SPDR. Other highly respected ones are IVV from iShares and VOO from Vanguard. They are essentially the same thing, with minor differences in their expense ratios, which are negligible. So, how do you, in practice, actually invest? The process is straightforward. Step 1. Open a brokerage account. A brokerage is simply a platform, an app or website that allows you to buy and sell investments. For beginners, I recommend established, reputable brokerages like Fidelity, Charles Schwab, or Vanguard. They are secure and do not charge fees to open or maintain an account. There are also newer options with very user-friendly interfaces like M1 Finance or Public. Step 2. Fund your account. You will link your bank account to your brokerage account and make a transfer. Depending on the brokerage and the ETF, you can start with very low amounts like $50 or $100, especially if the platform allows the purchase of fractional shares. Step 3. Buy the ETF. Within your brokerage's app or website, you will search for the ticker, for example, SPY. You will click Buy. You will choose the number of shares you want or the dollar amount if you're buying fractional shares. And then you will confirm the order. That's it. With that single transaction, you have become an investor in the S&P 500. Now, the most important part, and perhaps the most difficult, patience. After making your first investment, your mission is to avoid panic. The market will go down. It's a certainty. But history has shown us that it has always recovered. The key to success is consistency. Invest regularly, every month or with every paycheck, regardless of whether the market is up or down. This strategy is called dollar cost averaging, and it is extremely powerful. Set up automatic investments and then forget about it. Let compound interest do its quiet work over the decades. To quickly recap, what is the S&P 500? The list of 500 leading US companies. Why is it important? It offers instant diversification and a proven track record of long-term growth. How do I invest? Through an ETF like SPY, IVV, or VOO, bought on an accessible brokerage platform. Investing doesn't have to be complicated. Starting with the S&P 500 is one of the smartest and most straightforward decisions a beginner can make. With it, you are not betting on a single company. You are betting on the growth and resilience of the entire American economy. I hope this explanation has cleared things up and given you the confidence to take that first step. Thank you for listening.